Another RBA rate hike, this time against market expectations. But is this the last in the sequence from our central bank? Our latest views for domestic and global markets. A year on from the first hike in the cycle last May, the Reserve Bank delivered its 11th rise to 3.85%, after just a 1-month pause in April. The lower read on inflation out last week led the market to the conclusion that the RBA might extend its pause for another few months. But the message from the RBA this month was clear. They're determined to get inflation back near its target range in a reasonable time frame, and their current forecasts aren't seeing the decline in inflation quickly enough for their comfort. The cash rate is now back to levels not seen for over a decade, and while still not high in absolute terms, it's the pace of rate hikes that is the challenge, being the sharpest increase since the late 80s. The RBA reiterated their aspiration to keep the economy on an even keel as they try to manage inflationary pressures, and from here, as long as the cash rate isn't increased any further this year, their dual mandate of price stability and protecting jobs can be achieved. But a cash rate above 4% would make this outcome much less likely, with a sharper rise in unemployment. The jobless rate remains near a 50-year low at 3.5%, and the RBA are forecasting it to rise to 4.5% by mid-2025. But like their comments from the pandemic era of no rate hikes until 2024, a sharper rise in unemployment may be much sooner than this timeline. So the path for inflation from here will be critical for the RBA's policy decisions and how they impact on jobs. Inflation has clearly peaked, with headline CPI down to 1.4% in the first quarter and core inflation back down to 1.2% for the quarter. So progress, but in the RBA's eyes, not progress enough. From here, the annualised consumer price index should steadily fall to around 3.5% by year-end. But before we can get any relief via rate cuts, we'll need to see core inflation at or below 3%, which may be more than 1 year away. Other central banks are still hiking rates, with the US Federal Reserve set to exceed a 5% Fed funds rate. The UK are already above 4%, and the Reserve Bank of New Zealand is at 5.25%. So these countries are facing hard landings as they tackle inflation. For Australia, the soft landing scenario needs inflation to keep steadily moderating and the RBA to be comfortable with the pace of this decline. The Aussie dollar was also caught off guard by the RBA decision, jumping a full cent on the news. And from here, while we expect the RBA to be on hold for some time, which should add stability, a weaker outlook for the US economy should translate to a mildly higher Aussie dollar later in the year, assuming we avoid a hard landing. And lastly, volatility is building in equity markets, but property markets recovered another 1% in April after the RBA pause a month ago. Housing and rental shortages, together with a surge in population growth, are expected to support residential property prices into next year. But the record peak-to-trough decline of 9% is still likely to extend into the teens. Next week's budget will be eagerly awaited for announcements on increasing the supply of housing, as the primary issue we face today for property is the lack of affordable housing rather than the prices per se. And that's the market update from Leveraged.